Welcome back. This is Retirement News Online. So we're in what some people call an everything bubble. And by that I mean just about every asset class is expensive right now. Now this makes a traditional 60-40 asset allocation questionable. My guest is David Grossbard with Sylvan Financial Advisors in Englewood Cliffs, New Jersey. And David, thanks for joining us. So, since many asset classes seem to be correlated in some way, how can you truly diversify these days, David?
Well, Scott, it's great to be back here again, and thanks for the invite. You know, we are in some very interesting times out there where stocks look like they're at an all-time high. Bonds are very hard to get some yield out of, so there's really aren't that many great opportunities in the traditional asset classes. So a lot of investors have to look for alternative assets in order to try to be able to secure the income that they're looking for in retirement. So the goals still remain the same. You know, it's not really a 60-40 or a 40-60 based upon age. Young people should still be looking at equities, but again, you've got to be able to have that time to be able to withstand some potential landmines that go on in the equity market. For older people that are looking for retirement or headed towards retirement or even in retirement, having a balanced portfolio and taking a withdrawal can be a very dangerous game as well. What we look to do is we look to be able to take a portion of those assets where we can position them and give them some good guarantees, because at this stage failure really is not an option.
Now, it's been said that conventional static allocation models tend to confuse risk with volatility. Do you agree with that?
Yeah, you know, again, I've given a lot of my clients the quiz when they talk about risk, and I ask them to define it, and I've taken 10 clients, and each one of them has given me a different definition of the word risk. So risk is really what it means to each individual, and from there we can then determine what their real risks are. Risks aren't just markets going up or down. Risks can be running out of money in retirement. Risks can be not paying for their children's education. Risk could be not leaving a legacy. So whatever the risk is for that particular client, then we can adjust it based upon the volatility of the current marketplace and build a plan to ensure that they're successful.
That's David Grossbard in Englewood Cliffs, New Jersey, and this is Retirement News Online. Thanks for watching.